careful what you wish for, because what they have waiting in the wings and what they've been trying to implement for 50 years now, I think is much worse for us. There is a lot of people wanting to see the Fed end, thinking that because this is bad, removing it is inherently good. But let's think about the implications of what happens if we lose the world reserve currency status. America has served this purpose to the globalist agenda and getting people dependent. This whole thing, this whole scheme relies on the world continuing to demand dollars. Again, we have to understand that that's the system that's in place. If we were to just overthrow the Fed, what's waiting is also central banking, but from a much worse perspective than the current Fed has. Hey, what's up, everybody? Welcome back. This is Hans again, solo episode. Brian's done with his cruise, a little family vacation there, and now they are moving. They sold their house, bought a new house, same town, same area, but he's swamped with that. And even though moving within the same city, you realize how much stuff you've accumulated. And my wife and I are continuously planning for and thinking about our eventual move, most likely to New Hampshire in a year or two, whenever that ends up being, maybe 2 years. And not really looking forward to a cross-country move after talking to Brian and seeing what he's going through with that. But anyways, I want to continue talking about central banking. I want to talk about macroeconomics, and I want to do it the same way I did last time. I don't know if these will come out consecutively or not, but the first one, whether that was last week or a couple weeks ago, I was trying to approach the idea of central banking from the perspective of those who implement it. We got to remember, I'll say it again, the entire world takes these set of assumptions. Every economist, with a very, very few exceptions, believes the same premise and is on board with this kind of economic structure. And so even though there's a tiny sliver of people in the economics world, the professional economics side, who don't buy into this, and there's an even smaller sliver of the general population who even knows or cares about this, I've found the only people that are really actively against this are libertarian minded, into infinite banking, into an Austrian economics, some flavor of that or combination thereof. And so even though we are adept at recognizing the problem and the shortfalls of this system, our knowledge collectively of the actual machinations of the system is lacking, I think. Again, not trying to convince you of anything, but I want to put more meat on the bones for when we have these conversations, because we can't just read Creature from Jekyll Island, though we must. We can't just do that and think that the Federal Reserve is the root of all these problems without understanding how the system works today. I made the point last time that over the last 4 years, the real enemy has been the Treasury and Janet Yellen and the Biden administration. They were the ones turning on the money printers. And at the end of the day, it starts with Congress to begin with. The demand for money starts with Congress. And so just to refresh that, when Congress passes a spending bill, that is the impetus, that's the input factor for the eventual expansion of the money supply. And so that translates to the Treasury, who says, okay, you want X amount of dollars. In the example we used, you want $100 to fund gay operas in Cambodia, and you want to, chemically castrate girls in Africa, and you want to inject Haitians with whatever poison coming out of these miracle companies, we'll say. Whatever your policy objective is here, U.S. Congress, you want $100 to do it. And so we're going to go to the market and we're going to appeal to international investors. We're going to appeal to other countries, other sovereign wealth funds. We're going to go to individual investors in the U.S. here. And we're going to go to corporations and financial institutions and people that want to buy Treasury bills. And there are different dates on the Treasury bills. Typically, in a normal yield curve, the longer out you go, the more you're compensated for your money, unless there's high uncertainty, which is that yield curve inversion, which we might get to today. And so they sell what they can, and the Fed essentially comes in as the backstop. They're the lender of last resort, and they say, okay, you sold $60 worth of what you need. We're going to back up the shortfall, and we're going to create the Federal Reserve notes to do that. So that does expand the money supply. It's not incorrect to say that the Fed quote, prints money or expands the money supply, we know that inflation is the expansion of the money supply. The increase in prices is the downstream effect. Okay. But it's like blaming, it's like blaming Hershey's Corporation for why you're fat, or Coca-Cola Corporation for why you have diabetes. It's, yeah, okay, they supplied it, but you wanted it. You demanded it. They said, okay, if the demand is there, who are we to say? Who are we to say no? Simplifying things. Of course, you have this aggressive marketing by those corporations, et cetera. But, you ultimately have the choice to not drink the product or eat, processed food. And so we demand it. And by we, I mean our government. Allegedly they represent our interests. And so the government demands the money, and the Treasury says, all right, we'll do what we can. And then the Fed says, all right, whatever you can't do, we will. Right. And so that essentially is going to ensure that there will always be expansion of money supply, because when you give someone a blank check, they're going to spend it. It's pretty simple. You could do the experiment with a 5-year-old or a college student or a professional economist. If you give them a blank check, they're going to spend it. That's sort of the what we have to keep in mind when we're talking about who's at fault for this. Well, all of them. The system, it has an inherent flaw in that there is a blank check function. This lender of last resort means that we're always going to have that last resort. Now, the Fed, we talked about last time, the monetary base, and that is what we called state money, narrow money. That amount of money is determined by that's called monetary policy. Like, that is determining the amount that can be injected into the economy from the state. And then they give the ratio, the money multiplier, 1 over K, or we call it the fractional reserve ratio, 1 over K. So 10, the money multiplier being 10, then it would be 1 over 10, 10%. That's how much they tell the banks you're allowed to create. And so in the same vein, the banks say, hey, why would we restrict ourselves to making interest on one deposit of $100 when we could make interest on 10 deposits of $100? And I also oversimplified that, but the idea is that over the course of them holding on to 10% of the deposits that they get and then loaning out the rest, and then that remaining 90% going to other banks who do the same thing, on, eventually, it's not that I deposit $100 and all of a sudden the bank just says, boom, $1,000. It goes kind of in the other direction, but builds, if that makes sense. And it doesn't really need to make sense if you don't care. Just know that the net result in the economy over time, as the money is transmuted through the economy, is that $100 deposited in the bank becomes $1,000 into the economy total, including yours. And 10 people could have claim to $100 by the time it's all said and done. And that's all in the backing of or with the reserve of your $100. And so that would be with a 10% ratio. Technically, since COVID, it's still on the Fed's website that the fractional reserve is technically zero. Now, banks aren't going to operate at 0%, but theoretically they could. That's still on there. But I think they're operating, I believe, from people that are smarter than me about this, that they're operating typically in the 5 to 10% range, and 10's probably pretty generous. Because again, they don't have to. It's Parkinson's law. It's, time expands to meet the time given to complete a task. The idea that lifestyle creep, your budget expands. And so we know that there are these human tendencies. Congress has them. Your budget office has it in the military, and, or even the episode of The Office, they make an example of that really well, where it's like, how do we spend this extra surplus money? We have to spend the surplus or we're going to lose it next year. The military is a textbook case of that. But we all understand that when you get that budget surplus, what do we need to buy? Should we buy a printer? Should we buy chairs? A lot of us would do the same thing. And a lot of us, we got to be honest with ourselves. If we're running a business, or, we're getting an allowance, and your parents were to say, if you don't spend all $10 I give you, then if you only spend 8, then I'm only going to give you 8 next time. You're going to spend 10. You're going to find something to blow the 2 on. We all have this tendency. And so that's okay. That's inherent. That seems to be the natural response, is expansion and consumption. And if there's no cost to the additional consumption, you're going to consume. If there was no cost to, eating extra donuts or whatever, like people that have the discipline not to, because they don't want to get fat, would maybe eat the donuts if there's no cost to it, right? It's very simple human nature, I believe. And so Knowing that and recognizing that, we put in a system that facilitates that. It facilitates the extra consumption. So that is a problem. The system is good. And again, take none of what I'm saying as defending the Federal Reserve, as defending central banking. But again, we have to understand that that's the system that's in place. And if we were to just overthrow the Fed, what's waiting is also central banking, but from a much worse perspective than the current Fed has. I think Jerome Powell has the right perspective of the two options. Would I prefer no central banks in the world and honest money, sound money? Yes, but that's not in the cards. And so if the Fed falls, much worse, the European globalist central banking effort is ready to swoop right in. And we saw how quickly people will fold. Took the miracle for barely any incentive at all. Like, I want to go on a cruise. I want a donut, right? Social shame. It worked. And so the European Central Bank knows that, and they would get us hooked by tempting that human instinct. Okay, so let's put ourselves in the blame factor there as far as our demand cycle. And so but therefore we understand that, and we want to separate from that, which is true. But again, this is the whole purpose of this, is just know your enemy. Now let's talk about monetary versus fiscal policy. Those are two separate parts of the equation, and I just want to put some definition to that. You'll hear both of them, and fiscal, we know, has to do with money. Monetary obviously has to do with money. But when we hear those two terms, remember that the monetary policy is what the central bank is doing. That is the coordination between the Treasury and the Federal Reserve. That is determining that monetary base, the state money that's being injected into the system. That is the money multiplier. How much money can be created on the backs of existing deposits, right? Those things, and pretty much everything we talked about yesterday, was monetary policy. Fiscal policy is going to be Congress, and that's going to be your spending bills, and it's also going to be your tax rates. It's going to be what Congress is doing with money and what they are extracting from us in the form of taxes. You can think of that as fiscal policy. Just making that, not diving in deep into that distinction, but it's something that it's critical to know basically those two things. Fiscal policy is what our Congress does, what government does with spending and taxation. Monetary policy is what the Treasury and the central bank are doing with setting the monetary base, injecting money into, or withdrawing it from the economy in order to affect interest rates, in order to affect the price of money, and also that money multiplier effect. So fiscal versus monetary policy. What I really want to focus on today here is reserve currency. That's something we've all heard of. We know that the US has the reserve currency. We maybe know a little bit about Bretton Woods, but let's learn reserve currency implications from the other side, because there is a lot of people wanting to see the Fed end, thinking that, because this is bad, removing it is inherently good. But let's think about the implications of what happens if we lose the world reserve currency status, because we are benefiting from it, even though our dollar is being devalued. We're going to talk about the reserve currency, what that means from an economist point of view. We're also going to talk about Triffin's Dilemma, which ties right into it, which is the problem identified by a Belgian economist, Robert Triffin, who saw essentially, here's the crisis that America is going to face, or any country who's going to have the world reserve currency is going to have to face, in the decision of metallism and having a gold standard, for instance, in our case, and having a fractional reserve expanding system. So I'm going to read the piece directly from this book, The Encyclopedia of Central Banking. If you got a couple $100 to spend and you are a nerd and your hobby is economics, you can find this. It's occasionally pops up on Amazon. I had notifications for it, like I said, for 2 years, and finally it popped up. It's a collection of essays essentially on different topics related to macroeconomics, related to central banking, and profiles of various economists. And it's honestly really fascinating. I think that just reading through these is phenomenal for building up your education. So I'm going to read, and I'll throw in some commentary as it comes up, about reserve currency. Each of these essays are a page and a half, so that they're pretty simple, but we'll put a little more meat on the bones so that when we have conversations about reserve currency, and we want to think through its implications. All right. A reserve currency is a currency that is held by many governments and institutions in a notable quantity, which constitutes part of their foreign exchange reserves, i.e., other countries holding the currency of whichever country. So The rest of the world holds Treasury bill, and this is my commentary here. The rest of the world holds Treasury bills as part of their central banking reserves. It is as good as dollars. It is probably better than dollars having these T-bills. And that is what other countries purchase. When I talked about the Treasury going to the market and trying to sell their goods, that's what they're selling is T-bills to try to bring the money into the country. We say, hey, everybody who wants, in our example, the Congress needs $100. So, hey, we've got all these different T-bills. These $1 bills, T-bills, are for a 10-year and they're at this interest rate. Anybody interested? These ones are at a 5-year. These ones are at a 1-year. And so countries, depending on their liquidity needs, depending on how soon they want the interest, depending on the interest rates that are set for these, they're looking at the yield curve, and they're going to buy those Treasury bills. So going back to the article, the reserve currency is held by central banks to pay their country's external debts. So France and Germany could be settling their debts in US dollars, aka US Treasury bills. Back to the article. The reserve currencies in use in any historical period are usually widely accepted, and they make the pricing of goods and services in the global market less cumbersome, thereby fostering trade. Again, it gets back to what is the standard? What are we, it's much easier than trying to convert to these different currencies and figuring out, and there is a whole currency exchange market, the Forex market. But if everyone knows the value of a dollar, then it makes things easier. So it fosters that trade. Major global commodities priced in reserve currencies include gold and oil. No reserve currency is permanent, as one can see in the different currencies used in different historical periods and with different percentages of foreign exchange reserves. Examples include the 17th century use of Dutch guilders, the Roman denarii of the Middle Ages, Chinese liang and Greek drachma of the 5th century BC, and more recently, pounds, euros, and US dollars. The US dollar has been the main reserve currency since the Bretton Woods regime. This began as gold convertibility, i.e., US dollar reserves being sold at a fixed price for gold, $20 for an ounce of gold, as a result of the emergence of the United States as the major economy at that time. We're thinking post-World War II. Despite the collapse of the Bretton Woods regime, the US dollar has remained a major reserve currency. For a reserve currency to be used as a reserve currency, there are some determining factors to be considered. They are as follows. 1, the pattern of output and trade. The country's currency has to have a large share in international trade and finance. 2, financial markets. Capital and money markets in the country whose currency is being considered must be open, and here's a big asterisk, a big foot stomper, free of controls, and that country's economy must also be deep and well developed. 3, confidence in the currency. The exchange rate of the currency must not fluctuate erratically. Many reserves are held in the form of government bonds, not just cash. Hence, to be a reserve currency, these government bonds have to be tradable across borders without fear of default risk. We always hear backed by the full faith and credit of the U.S. government, right? That means something, even though we laugh at it, we kind of scoff at it now, but that means something, as evidenced by the fact that for decades now, other countries have been bidding on and purchasing T-bills and holding them as tier 1 assets in their reserves. It's a liquid currency between countries. And 4, network externalities. Other countries have to be willing to and actually use the currency. If a currency is widely used to invoice trade, there is a higher chance of that currency being used to invoice financial transactions as well. Regardless of its intrinsic value, wide acceptability is key in the consideration of a reserve currency. Like a domestic currency, the willingness of other people to accept a currency is a determining factor considered in a reserve currency. There are several benefits and costs accruing to a country whose currency is used as a reserve currency, and also to countries using it. Among the benefits of a reserve currency, including seigniorage, which is the difference between the face value of a coin, for instance, and the cost of production. So if everyone's using your coins and you can produce them cheaper than the actual value, if someone's going to buy it for $5 and it costs you $4 to produce, that's seigniorage, that difference there. So among the benefits of a reserve currency, including seigniorage, lower government and private borrowing costs, and other non-pecuniary benefits such as the international prestige accrued to a country from having its currency used as a reserve currency. Let us elaborate on some of these benefits briefly. As regards seigniorage, this is a spending power reallocated to the monetary authority issuing a reserve currency and will also be extended to the country as a whole. Again, if everyone's paying $5 per unit and it costs you $4 to produce that unit, you are inherently earning that net there. An economist, I'm going to just say an economist when with all the names and citations here. You can look in the book, and if you want to read more about. The economist explains seigniorage benefits as the excess of the opportunity cost of capital over the cost of providing the fiduciary asset. In this case, the fiduciary asset is the reserve currency. If a country issues a reserve currency, its government can enjoy the ability to buy goods, services, and assets from other countries using its own currency, while non-reserve currency countries cannot do this. Furthermore, reserve currencies allow their issuing countries to sell both private and government debts in their own currency and at a lower interest rate. In addition, reserve currencies have the attributes of a natural monopoly, and using countries find it easier to trade with the currency that most countries use rather than incurring the extra transaction costs of trading with another currency. It's kind of like, when we think of monopoly, that's economically speaking, that could be illegal, but at the end of the day, we use them. They become monopolies because everyone uses it for convenience, right? Maybe Amazon has a monopoly in the book selling space, but that's because we all started buying books there, and so that monopoly formed as a result of there could be government policies that accelerated their growth. But at the end of the day, most of us are using Amazon Prime, and so that monopoly kind of builds semi-naturally. But we all understand how having that ease of access, being able to log in and buy something that's there by the end of the day, we would rather do that in a lot of cases than trying to go and drive around town and find a store that specifically has the thing you're looking for. And so the same thing with currency. If I don't have to go and exchange my currency into another country's currency, pay a fee to do that in order to do a trade, when I just say, hey, you just want to do this thing in dollars, and they say, yeah, of course, that's the benefit that you get as a reserve currency. As regards the cost of reserve currency, economists points out two aspects. Some countries might peg their currency to the reserve currency, which makes them use their own domestic currency as a macroeconomic shock absorber. For example, economists 1 and 2 show that during the global financial crisis that erupted in 2008, the fear of reserve losses made emerging markets depreciate their currency instead of reducing reserves to foster economic recovery and stability. This is because they feared that losing reserves too fast might propagate a run on the remaining reserves. Economist explains the danger of a reserve currency with respect to exchange rate pegging. By pegging to a reserve currency, the currency user, aka in this case another country that's not the US, would be allocating a part of its sovereignty to the issuing country. Also, the issuing country could suffer depression of aggregate demand and losses of jobs and industries if it does not adopt a policy to ensure full employment at home. My interpretation of that is if you think about the value of having some control over the levers, he's saying that if you're a country that has dollars and you peg your currency to the dollar, you're ride or die with us. You don't have as many levers as a central bank in that country, because if the dollar goes up or the dollar goes down, you are beholden to what the dollar is doing. An advantage to being a non-dollar is that we lose some of the benefits, like the seigniorage, like the flexibility of policy, because hey, whole world wants what I'm selling, so I get to control the terms, right? That's a benefit. But at the same time, when things go bad, the example he cites in 2008, you have a lot more levers to pull if you're not pegged to the dollar, but you enjoy the liquidity and the ease of transacting in dollars. But you can devalue your currency. You can make your currency more appealing for trade by devaluing it, so that it's cheaper to trade in your currency during a time of shock. And so it's like, you have these countries that are sort of riding on your back, but if the ship starts sinking, they can hop off and they can manipulate. They have a few more levers that they can do from a monetary policy perspective than those who either have the world reserve currency or who peg their currency to it. The second cost of reserve currency that he cites, greater financial integration will make it easier to transmit external shocks to the reserve currency economy. Countries with high volume of reserve currency in their foreign reserves, China, will be more exposed to shocks than the issuing currency faces. As the world is a global market, economists 1 and 2 show empirically that the higher the total foreign liabilities to GDP ratio a reserve currency country had, the more vulnerable it was to the global financial crisis that burst in 2008. If so, then a country with a relatively high volume of reserve currency, US dollars, which has the highest percentage in the currency composition of the official foreign exchange reserves, i.e., more people are holding dollars than anything else, and it's not even close, was susceptible to experience the financial crisis that started with the housing bubble in the United States. We know that China holds a huge point of leverage over us in how much of our T-bills they own. And so if China started fire sailing their T-bills, it would cause an economic crisis at home. That is a problem that other countries don't have to deal with, because it's kind of like if you're the king of the hill, you have power, but you also have some exposure and you have people coming after you. And so that cost, that number two concern there, to me, speaks to in an example we understand is how China has a say in our T-bills by being such a huge holder of it. Same kind of way with like say a cryptocurrency, where the company that issues it, or like the Trump coin, right? The manufacturers of that, this kind of pump and dump coin, I think they held like 80% of it, or even more than that. And so you get this huge spike, you get a ton of money that pours in, and because you control the majority stake, right before it tanks, you can just sell it, right? And so that's kind of a simplification of that, but those are the kind of the costs of having the world reserve currency. Back to the article, we can add a third aspect. A currency used as a reserve currency is prone to exchange rate appreciation as a result of an increase in demand for that currency. This would result in the costs of its exports being higher for other countries, and thus a decrease in its exports. Though the exchange rate appreciation will benefit imports, the total effect on trade will depend on the percentage of exports and imports. Remember that countries devalue their currency to make it more appealing to do trade with them. And so if everyone wants dollars, and that brings the value of the dollar up, dollar valuation versus devaluation, then that makes trade in dollars more expensive for the issuing country. And so we might suffer a trade imbalance due to the power of the dollar, when in international trade, having a weaker currency will attract trade to your country. Okay, so that's the article on a reserve currency. I want to roll right into Triffin's Dilemma, because this outlines the decision point that we had as a national economy. And so as we're reading through this little piece on Triffin's Dilemma, think about how we refer to ending the Fed is what we have to go through by having this backstop, by having the Fed, by having this fractional reserve system. If this were to go away and we go back to this gold standard, this is what they were trying to think through as far as which way to go. The Triffin Dilemma is named after Belgian-born Yale economist Robert Triffin. Referring to the role of the US dollar as the world's key reserve currency under the Bretton Woods regime established at the end of the Second World War, Triffin identified the following conflict: that continued growth in global trade and production was dependent on an elastic supply of dollar liquidity, but the U.S. gold holdings into which said dollar liquidity was convertible was essentially fixed. That should intuitively make sense to us, because if the dollar is pegged to gold, $20 per ounce of gold, and the amount of gold, as he says, is essentially fixed, then that means that the supply of dollars is essentially fixed. The only way to have more dollars is to mine and produce more gold that the US holds, right? And so if we're fixing that, and the demand around the world, if people want liquidity, if they want credit, if they want access to capital, that demand is going to, it could essentially break the reserve currency status. Now, of course, the reserve system, the dollar, or the gold standard system is a much more sound policy. You don't have inflation, right? Because you have to actually produce, you have to actually earn those dollars that you get. They can't just be created because they have to be backed by gold. Otherwise, the system falls apart. And so that is a much more sound option, yes. But at the same time, that works, I think, on a smaller scale. If you're assuming you have this global economy and you're assuming that there's going to be a world reserve currency and a large country is willing to become the world reserve currency, someone's going to do it. And so at this point, it made sense for the U.S. as emerging from World War II, relatively unscathed compared to the rest of the world. It was a prime time to step up and take that mantle to fight your way up and become the king of the hill, which is essentially what happened at the Bretton Woods conference. They decided that the world would trade in dollars, and dollars would be fixed to gold, and that gold would be held in the U.S. and we have sound money, so we don't have inflation. We have a much more soundly functioning economy. How long can that actually last on a global scale? Well, we've seen it, and every time it's turned into every country seems to have taken the other route here, which is what Triffin describes. All right, so we know that if we have a fixed supply of gold, we have a fixed supply of dollars, and therefore, if everyone in the world wants dollars, they become harder and harder to get. That natural human tendency, hey, let's take the easier route. How do we create more dollars if the whole world wants them and we benefit from it? We, as in the American economy, it's tempting, right, to devalue your dollars in terms of gold, which is eventually what happened, and then to pull yourself off the gold standard entirely, which is also eventually what happened. It's tempting because you say, hey, what is the cost? So like, we can create more dollars. The whole world wants them. We have this power of creating it. So we get all these benefits we just talked about in the last piece. If we want these benefits, we're going to have to play ball. And so that's going to require us, so the dilemma goes, to eventually remove ourselves from this peg. Otherwise, someone else is going to step up, devalue their currency. And if the whole world wants it, then we're going to lose that reserve currency status. So back to the article. The United States and the world were therefore facing a critical dilemma. Triffin concluded, either the United States could strictly control its balance of payment and tightly limit outflows of US dollars, which would protect the dollar and its gold backing, but put the global economy on a deflationary trajectory, or the United States could tolerate whatever external deficit and expansion of the US dollar liquidity that growth of the global economy might require, risking an eventual dollar crisis given that the dollar's gold backing would become increasingly thin over time. I'm going to break that apart and read it again because I think that is exactly it. So option one, we could control the balance of payments. We could limit the outflow of US dollars. Doing so would protect the dollar and its gold backing, but it would tamp down global economic growth. Other option, the United States could tolerate whatever external deficit and expansion of the US dollar liquidity. So we could say, if you guys want dollars, we'll give you dollars. We would tolerate what demand the global economy might require. If everyone's saying, hey, I want dollars and I want more of them, do what you need to do, give me more dollars, because everyone wants dollars in the world. So if I have more dollars, I can grow and I can leverage, I can capitalize, all these terms that we know and understand as infinite banking practitioners. We understand why that's appealing, to have more of your asset, more capital that you can leverage and grow. So we could in this option, we could say, all right, whatever comes, if the global economy wants it, we're going to provide it. Therefore, thereby risking an eventual dollar crisis, given that the dollar's gold backing would become increasingly thin over time. At this time, before Bretton Woods, when we are deciding if we will be a reserve currency, we had $20 an ounce pegged to gold. $20 and 69 cents, maybe 67 cents, I think, was the convertibility from dollars to gold. At Bretton Woods, they said, okay, well, we understand we need to expand this. The world wants more dollars, but we still want a gold standard. And they devalued the dollar by changing the exchange rate to $35 an ounce. However, we still had this gold standard where these dollars were convertible at $35 an ounce. So far, after Bretton Woods, that was the idea, was that we can exchange I say we, I'm talking about other countries. When we're talking about reserve currency, we're talking about central bank to central bank. Other countries could exchange their dollars to gold for $35 an ounce. This gave other countries that confidence that they could interact and trade with dollars, but knowing that it was backed by something. Okay, I'm going to read those again one more time because I think that is the highlight of this. Triffin concluded either the United States could strictly control its balance of payments and tightly limit outflows of US dollars, which would protect the dollars and its gold backing, but put the global economy on a deflationary trajectory, option one. Or option two, the US could tolerate whatever external deficit and expansion of US dollar liquidity that growth of the global economy might require, thereby risking an eventual dollar crisis, given that the dollar's gold backing would become increasingly thin over time. The piece goes on. The Triffin Dilemma concerns the foremost question in international monetary relations: which or what kind of currency should serve as international money? Given the circumstances prevailing at the time, the Triffin Dilemma actually features two critical aspects and potential sources of tension. One is that convertibility of a currency into something else puts an important constraint on the issuer of that currency, whether used only nationally or internationally as well. Historically, this issue was long held to be an advantage and safeguard against currency debasement. So if we have this gold standard, even though the world wants it, we're prevented from devaluing it any further because we're still beholden to this exchange of $35 an ounce. By contrast, Triffin alerted observers to the Keynesian concern that economic expansion presupposes growing liquidity, while monetary restraint and deflation would be adverse to economic growth. This also intuitively makes sense because, again, if every country wants dollars and there's a very, very finite fixed number of them because it's based on how many ounces of gold we have, it's expansion and growth and financing become a lot trickier. And this is a good thing in the sense that we talk about, an insurance company that has 100% reserve requirements for their current outstanding liabilities, i.e. every policyholder could go and surrender their cash value and that money exists. It has to exist per regulation. That's a good thing, right? Versus the banks where that money doesn't exist. We've covered what that the fractional reserve ratio, the money multiplier, where if every depositor in the bank went to get their money, only a small fraction of that money actually exists. So they paper over that deficit with FDIC insurance. FDIC insurance itself is also essentially bankrupt. They have about 1% of their total liabilities, maybe 4%, maybe 5%, single digit percents of their liabilities. And something like Silicon Valley Bank going under takes out a huge chunk of their what they actually have. And so the FDIC system is also subject to bank runs and is also a huge gaping problem. But monetary restraint and deflation would be adverse to economic growth if we're talking about a global economic expansion. Back to the piece. The other source of tension is that if one and the same currency serves both national as well as international monetary functions, this may present both special advantages as well as special challenges to the issuer of that currency compared to its international users. That's what we covered in the last piece. Special advantages are mostly associated with enlarged policy autonomy and profits from currency issuance. Given that all other users of the international currency, i.e. all other countries that use dollars, have to obtain their reserves, their dollars in markets through exchange of products or assets or through borrowing, whereas the issuer can simply produce these reserves, the currency issuer enjoys an extra degree of freedom in policy making. Other countries have to provide some value, sell things to the US, sell things to other country in order to generate that revenue, in order to purchase and acquire treasury bills and acquire dollars. We don't have to do that because we have the advantage of being the world reserve currency. So if we can't sell our goods, we can just make the money because the world demands it. This whole scheme relies on the world continuing to demand dollars. And who enforces that? The US military. What happens if a country wants to peg their currency to gold? Saddam Hussein, Muammar Gaddafi, we spread some democracy all over their ass, right? The US military is the enforcement arm of the dollar's status as a world reserve currency. We get this extra degree of freedom in policy making. We have a lot more levers we can pull because we have this safety net as long as the world is actually wanting our currency as reserves. If production of reserves actually uses up few real resources, The currency issuer also enjoys a profit or exorbitant privilege in terms of products or claims obtained in exchange for those reserves. That gets back to the seigniorage. Everyone wants it. Everyone's going to pay 5 for a unit of currency, and it only costs us 4 to produce. In essence, Triffin pointed out that the policy autonomy and special privileges from reserve currency issuance may prove illusory rather than real as soon as the convertibility commitment of US dollars into gold, in our example, becomes binding, and that this might represent a problem not only to the issuer itself, but also to the world at large. Put differently, and contrary to all good intentions at the Bretton Woods conference, the world economy might still be bound by the remnants of the gold standard. Unless ways were found to sufficiently grow gold, the quote barbarous relic might still end up acting as a brake on economic growth. Now, here is where we see how they view it. Here's where we get into the heads of proponents of central banking. They don't want the gold standard. They don't want to be constrained. They don't want this brake on economic growth, which is what they view sound money as. We want sound money. They don't. They don't see this as a good thing. Like, I imagine that when I read this and I'm hearing about the dangers of having, the way they view it, the dangers of having a gold standard and this break on economic expansion, I'm like, yeah, that's a good thing. That makes sense. But you see, the author's perspective here is that those are the hurdles to get over, is this break on economic expansion. So this is where they're all coming from. They view, I mean, I get it. The economic expansion is good. And to be fair to them, if you're in another country, how are you guys, you might say, how are you guys complaining? How are you IBC guys, you Austrian school thinkers, like, how are you complaining about this? The reason that you get to buy an F-150 every 8 years if you want it or whatever, you guys get, everybody there has a car. Like the human to car ratio is close to 1-to-1 in your country. How can you guys all buy these 30-year mortgages? How can you buy $1 million house? You don't provide enough value to, your labor is not commensurate with the spending power that you have. Well, it's because the Cantillon effect. We talked about that last time. We're in front of this global line for dollars. Yes, they're being devalued, but we are the beneficiaries of that. Our life, the fact that we can go to the bank with a mid-level credit score and some money in the bank, and we can leverage a little bit of money, 20% down to get a house. Of course, yes, caveat, the house prices are a function of this. If you provide free money, just like college tuition, if the government writes a blank check for college tuition, yeah, of course, prices are going to skyrocket. Again, getting back to that human element. So this system doesn't have the necessary brakes on it. This is the logical conclusion, and we're kind of reaching that pinnacle point right now. And so they view gold, they view having a reserve currency pegged to something that we would call sound money as a brake on economic growth. And we need to understand where they're coming from. Back to the article. On the other hand, special challenges are mostly associated with the potential need for the reserve currency issuer to generate overspending and tolerate persistent current account deficits as the source of the global liquidity demanded. Accepting persistent current account deficits will typically imply a certain degree of currency overvaluation or lack of competitiveness. We touched on this in the last piece, which may harm some industries more than others. Will also benefit some parts of the population more than others. Domestic political economy issues are thus bound to occur. Historically, the Bretton Woods regime actually started out fearing a dollar gap, the opposite of Triffin Dilemma identified later. At the end of the Second World War, the United States had not only accumulated the biggest part of the global gold stock, together with sizable claims against European nations. In contrast to widespread devastation in other economies, the U.S. had also expanded strongly during the war and was in good shape to enjoy the peace. How could an indebted and devastated Europe obtain the U.S. dollars needed to pay for the American products that European reconstruction was to depend on? And how could the United States sell its products and sustain economic growth in the first place if its potential buyers could not dispose of U.S. dollars? So the opposite problem at the time is what they saw. They said, hey, the other countries, like, we want the reserve currency, but the other countries don't even have the means to acquire them. So there's this dollar gap. Now there's a dollar overload. He says John Maynard Keynes had designed an ingenious plan to overcome these challenges through the creation of a new international currency. That's the Bancor system, which never came to fruition. In short, the Bancor system is essentially like a central bank for central banks, and it sets up, from my understanding, equivalent to the SBR or SDR, the special drawing rights, but it's basically like a currency created by the world central bank to do what our central bank does in the economy, i.e., we're going to set our monetary base in bancors, i.e., global currency, and we're going to control monetary policy among central banks and do it's the same thing we talked about with what our state money does in as far as setting the monetary base and the multiplier, except they're doing it fractally a scale up, and they're doing it for the other central banks. That was Keynes's Bancor system. So Keynes had designed a, quote, ingenious plan to overcome these challenges through the creation of a new international currency, but his American counterpart, Harry Dexter White, prevailed at Bretton Woods. White wanted to establish the US dollar as the unchallenged international reserve currency. He failed to grasp, however, how his foremost aim might conflict both with restricting other countries' right to restore their competitiveness through currency devaluation, as well as with the prominent place he still reserved for gold in his international dollar order. You want to expand, you want to be the world reserve currency, you want every country to demand your dollars, but you're putting a brake on it by having this gold standard. So Triffin identified this early on. The former issue dominated in the US dollar gap of the 1950s, and then the latter came to describe the dollar glut, or the Triffin Dilemma, of the 1960s. The former was addressed through the Marshall Plan, providing the world with US dollars through grants. The latter was ultimately solved through ending US dollar convertibility into gold in 1971. Now we see that from the other side. France wanted its gold back, and Nixon took us off the gold standard. And they closed the gold window. They said, tough luck, we're keeping your gold. And other countries are like, well, what do we do? And so what are we going to do? Go to war with the US? This is in 1971. Of course not. France isn't going to go to war with the US, and they just took the loss. They had to, because for a few decades we had been the reserve currency. And so they're like, well, this is no good, but we still need dollars, right? So, and again, you can see the perspective here that these authors have. Ending the US dollar convertibility into gold was a problem solving solution, right? That removed the brake. We see that as a bad thing, but they see that as that was the solution. That was the ingenious solution where they ultimately solved this issue. He goes on to say that, note that ending convertibility got rid of one aspect of the Triffin Dilemma, and critics might argue that the risk of deflation was merely substituted by the risk of inflation. Yes, of course we would argue that, now that the gold anchor was gone. However, fundamental conflicts would continue to arise between domestic and international policy requirements anyways. Under the new circumstances, the reserve currency issuer does indeed enjoy a large degree of policy autonomy. The irony, however, is that other countries' defensive policy choices, that's what we talked about last time, you have more levers to pull if you're not pegged to the dollar, and you can allow the dollar to sink relative, and you can kind of unhitch yourself, and you can devalue your currency. The irony, however, is that other countries' defensive policy choices may come to place an enlarged burden on the reserve currency issuer in terms of satisfying the international demand for reserves through current account deficits, which in turn are sufficiently large to create domestic tension. Since the global financial crisis of 2008-2009, the United States has resisted playing that part. In the bargain, that issuance of the global reserve currency tends to involve, and even by 2014, the world economy has yet to get its bearings. Ultimately, the conflict can only be overcome by creation of an international currency that is trying to say the Bancor system by Keynes that is not subject to national policy control as suggested by both Keynes and Triffin. Okay. So their end goal here, they're telling you the conflict can only be overcome by the creation of an international currency. The Bancor system, a modern equivalent of it, global central bank and a global currency is what they want. Now we know this. We hear them talking about this. They're not shy about it. They want to reduce our autonomy, and I think that America has served its purpose to the globalist agenda and getting people dependent, and the same way that France was dependent, so that when they took their gold and said, hey, like, you're just not going to get your gold back. Sorry. You're still going to transact in dollars. I know you still need them. You're not going to do anything about it, right? We're the king of the hill. You're not going to do anything. In the same way, I think they're going to say that to the Americans. They're trying to. They're saying that, hey, like you're dependent now. You as Americans, you're lazy. You're used to a life of comfort. If we can take that comfort away, i.e., COVID lockdowns, et cetera, if we can take that comfort away, you're going to accept. Like you're going to go with whatever we want, and that's why. Getting back to Joe Withrow, that conversation we had with him, and his theory on the two competing central bank factions. The bad guys right now, from our perspective, is the globalist, the EU central bank plan that wants this international currency. And in my experience, the political economists, that's what they want too. And so we are, in a sense, at war with them, economically speaking. And I think that Withrow nails it when he describes what Jerome Powell is trying to do in saving U.S. banking interests. Now, is that like this good-hearted crusade? Not necessarily. No, it's not. It's protecting his own industry, which is Wall Street. But that currently between the two options is by far and away better for us. And so I'll sum it up with this: be careful what you wish for, because what they have waiting in the wings and what they've been trying to implement for 50 years now, I think is much worse for us. So there is a way in the IPC community. Dr. Robert Murphy has outlined the sound money solution along with the folks at the Nelson Nash Institute as far as a potential roadmap of how you can reduce reliability on the Fed by having more people doing IBC. The less of us that are dependent on banks, the more autonomy we have, and we can reduce over time the Fed's role and eventually remove it. But to remove it right now, when the whole country, like if people aren't doing IBC, you do not want the Fed to end. And that's the irony we get back to. A lot of people that when we have conversations and people are interested in this, but hey, I got a buddy who's financial advisor. I got a buddy who's my uncle says that, buy term and invest the difference. Whole life's a terrible place to put your money. What is that assumption based on? That's saying that we should be in the market. It's always comes back to that. You shouldn't put your money in whole life insurance. Forget these contractual benefits that we don't even understand. We're just going to say this is a bad investment. Don't put your money there. Put it in the market. The market's going to grow. The market always goes up and right. Well, why does it always go up and right? Because the supply of money always increases. Why does the supply of money always increase? Because there's a backstop that says we will come up with the remaining money. And so you better be the biggest Fed cheerleader if you are saying, I'd rather invest my money in the market than put it into this contract with contractually guaranteed growth and an ownership stake in the company and all of these living benefits we talk about. If you're going to say, I'm not going to do that because I want to invest in the market, you better be cheering for the Fed right now. You better be out there, pulling for them to succeed. So you cannot say, I'm not going to do IBC because I want to make more money in the market, and at the same time say in the Fed. That's retarded. Those two things cannot exist if you have any kind of understanding of the underlying macroeconomic conditions that are at play here. And that is my goal with this episode and the last one, is just to provide a bit more depth on this conversation. And I might do some more. I asked in the last one, which I recorded last night, actually, if, for feedback on this, if this makes sense, if this is helpful, if you want to hear more, because I would love to go through a lot more articles in this book. And I would like to talk through a lot of the books that I have on the shelf back there that talk about the history of money, because I think these other perspectives are critical for understanding what we're up against. I haven't had time to get feedback because the first one wasn't even released yet. So of course this one's not either, but I would like to know other topics if you are interested in learning more about this, because I love deep diving on this stuff. And I might probably have a book on a topic that people would be interested in. And I would love to talk through it. So all that to say, know your enemy and be careful what you wish for. All right. Cheers, guys.